Hello and welcome. You are listening to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. And my name is Goose. And on today's show, I had a special guest, Vanessa Newton, who is from Dashot. She's the operations manager at Dashot. But what we did today was we actually collected, or Vanessa did actually, collected a bunch of questions that have been asked by friends and family members, team members, and all of that kind of stuff to get them asked on the show. And this is something we are really excited about doing a little bit more so that we can get more questions answered on this show to give more answers to you guys. So we talked about heaps of really awesome stuff. We talked about, why, interest with fixed versus variable interest rates. Where is that appropriate? Who does that apply to? How should you think about that kind of thing? Bearing in mind, none of this is financial advice. Go speak to a professional, all that good stuff. We also talked about if it's ever too late to start investing in property and how to think about that. We also discussed things like, will there be a good time to buy in Sydney? What is the impact of projects like the Badgerys Creek airport completion and all of that kind of stuff, as well as how to think about buying an established investment property versus buying something like a new investment property. So we covered a lot of ground, and I'm confident that even if you think that you are an experienced investor, you're going to find some really good stuff in here. So I am really excited for you to get into this, and I can't wait to share it with you. So if you also want to get your questions asked and answered on this show, then send us an email to til@dashot.com.au. Without any further ado, let's get stuck right into it, and I'll see you on the inside. Hey guys, welcome back to the Investor Lab. Joining me today is a very, very special guest, Vanessa Newton, who works at Dashot. Vanessa, how are you?
I'm really well. Happy Thursday.
Happy Thursday to you indeed. Although it might not be Thursday where the listener is. So whatever day it is, don't get confused, right? It is Thursday in our time, but we live in a quantum universe. So it could be any time where you are. Who knows? Everything is and is not at the same time. Vanessa, welcome to the show. It's really nice to have you here. Most people, or actually, I say the vast majority of people who listen to this podcast will have absolutely no idea who you are. So before we get into it, I want to do a whole expose on your kind of like property journey and stuff like that. We're going to do that later. That's not the purpose here. But just to intro yourself, like what do you do? Tell us a little bit about yourself.
Yeah, so I am the operations manager for Dashot. So all of the magic that happens on behalf of our clients happens in the Dashot team, and I'm overseeing all the awesome team leads and people that all of our clients are in contact with every day, and all the engine room goes on behind that. That's my privilege to be involved in every day.
Yeah, and it's no mean feat. I think we're about to have a team of 60. So you're you're steering quite quite a decent sized ship with a lot of moving parts. So it's no mean feat. Now, why are you on the show today, Vanessa? What are we going to be doing today?
Yeah, so I'm obviously chatting with our team every day, of course, and they get some really cool questions coming in from clients. It seems to come up quite often. So I've got some of those questions that I thought I might throw at you, and of course, all of our team listen to it, and it can help them help their clients. And if they're questions that our team are being asked, I suspect that they're questions that a lot of people are as well, and the listeners of the show. So questions from our team, but also questions from our friends and family. Of course, when we're working in a property business, we get questions all the time. They're curious and they think that we have all the answers for them. And so we have some questions from family and friends as well to throw in there. So I might grill you for a few minutes if that's all right.
That sounds awesome, right? And so this kind of Q&A style of episode is something we want to do more of, and I've just done a couple of them recently. And just to remind people, if you have questions that you want asked on the show, maybe by Vanessa, maybe by somebody else, who knows? But if you want to get them asked on the show, just send an email to TIL, that's TIL, which stands for the Investor Lab, TIL@dashot.com.au. Shoot through your questions, and then if you are lucky, then we will tackle it on the show. But I'm excited. Let's get stuck into it.
Let's dig in, ready to roll. So first question is around interest rates. And so particularly at the moment, interest rates are quite low. And so we have some clients asking us why fixed interest rates aren't better.
It's a good question. I'm going to put a huge caveat on this at the start. Not a mortgage broker. This is not financial advice. I'm not able to do that. And if you're taking financial advice from a podcast, you've probably got some bigger issues, right? But this is so. That being said, let's talk about this. Let's talk about the thesis behind this and where and why and how it might or might not make sense. So I'm going to start with a story. So when Gabby and I first started investing, we bought, and one of the properties we bought, we ended up buying with a fixed loan, so it was fixed interest. And the interest rate was really high. It was a pretty shitty loan, but it allowed us to buy the property, right? And the problem that we faced with that is that it was a pretty high interest rate, and it wasn't really a great loan structure. But in order for us to break that loan, because it was fixed, we had to pay what's called a break fee. And now that was like $5,000 at the time we were looking at it, at which point we were like, we were trying to, we wanted to refinance it down to a lower interest rate. But when we did the calculations on how long was left on the fixed period versus how much we would save by going to a lower rate, versus then overlaid the break fee, we found it didn't actually make sense. So it sucked because we had to pay a high interest rate, and it was like really inefficient, and we really didn't like it. But the benefit of or the cost of breaking the loan term didn't make sense just to get it back down to a lower rate. So we just had to basically suck it up, which was kind of shit. Now, fixed and variable rates matter to different people for different reasons. Okay, so I would suggest that if you are a homeowner and you have non-income producing debt, and you are thinking about wanting to lock in a lower rate on your home loan for a period of time, and also if you have no plans to use the equity out of your property in order to fund your property portfolio, so you're not looking to do any refinancing, then that could make sense. That can make sense, right? But for an active investor, for someone who actively wants to try and do things like refinancing or growing their portfolio and doing all this other kind of stuff, firstly, interest rates don't really matter to property investors as much, right? So it really matters to homeowners, because as interest rates go up, affordability goes down, and they can really find themselves in a really tricky situation because it's literally coming out of their pocket. But rents go up in investment properties faster than wages do, generally speaking, and the investment dynamic changes as interest rates go up as well. So what you'll find is it'll sort of find a bit of an equilibrium as we go. So it's less impactful for property investors, really impactful for homeowners. So for investors, it probably doesn't make as much sense because your returns are going to be variable and be impacted in the market by interest rates as well. Generally in a not in a negative way, despite what the media says. And also, you want that ability to be able to continue to refinance property. Now, what you've got to look at is what is the hurdle rate of return. And so for a lot of investments, certainly let's think about this from an ROI perspective. So I know that I'm rambling a little bit, so feel free to jump in here, Vanessa. But if we think about it from a return on investment perspective, the average return on investment that our clients get is around about 70% in the first 12 months, right? And so when you're talking about a cost of debt of, say, 3% versus 4% or whatever, versus the access to capital to be able to make those kind of gains happen, access to capital becomes the far greater priority than things like interest rates. So being able to maintain the agility in your portfolio to be able to refinance, get cash, or get capital, get debt, all of that kind of stuff, is the critical factor in building a prolific and profitable property portfolio. And taking a more short-sighted view of I'm scared that interest rates are going to go up, therefore I'm going to lock up my portfolio for the next 2, 3, 5 years, that can actually put a real big break on your ability to achieve your financial goals in the time that you want to do it. Does that how would you rate my response?
Thorough.
Does that kind of answer the question? Did that answer the question for you?
Yeah, it does. And it makes me think about, say mortgage brokers. So as you're saying, that's where they come into their own and really deep diving into each individual person's circumstances and making recommendations on where they think that they should be doing it. Have you seen the differences in some mortgage brokers, ones that have the capability and the interest to look at their clients' portfolios in the way that you're talking about, or ones that are a little bit more risk adverse and sort of might not recommend going down that path, even though the client is wanting to invest in properties?
Yeah, so there's a broader issue there, and it's more about actual understanding, right? So they're just in the same way that in the property space there are 99% of property professionals in the property space really don't understand what the hell they're talking about. They have no actual idea how property actually works, or how to actually build a property portfolio that's going to achieve the goals, right? So they don't understand how to avoid how to help people avoid getting stuck and things like that. Same thing goes with mortgage brokers, right? Anyone can write a loan, and if your belief system is like, well, the lowest interest rate is the best outcome for whoever, then that is going to put you down a path where you're going to make suboptimal choices, when actually the goal for most property investors is to achieve financial freedom, whatever that means to them. It could be whatever that goal looks like, but it generally is a target and something they're aspiring to achieve, and a place they're trying to get to, which requires momentum and liquidity and movement and all of this kind of stuff. And so when you have brokers or professionals or anyone who doesn't take that into consideration, that's where people get stuck, right? So you got to remember the largest sample set of property investors are at zero properties. They're still struggling to work out how to get started, analysis paralysis, all that stuff. Second largest get 70% of them who actually get started get stuck at one property, and another 19% get stuck at two, which means that 90% of property investors never get past two properties. The reason for that is because of a misguided view on things like interest rates. Oh, I'm worried I'm going to pay more. You got to remember, we're at the lowest rate time in history. Even if rates start, let's say when rates start going up, right, we're still going to be ridiculously low interest rates. If you go back to the 80s, it was like 18%. And here's the thing, and I've talked about this a lot on the show before. There is no there is no causation or even a direct correlation between interest rates and property prices, right? And so even in the 80s, when interest rates went up, property prices also went up, right? So thinking about this in context, you've actually got to think about what is the broader objective of anyone involved. And so, yeah, in my experience, most people get stuck because they don't know what they're doing, but then they go and try and find professionals to assist them. But then those professionals also have no idea what they're doing, and then net result is client gets stuck and they wait 30 years, crossing their fingers, hoping for the best, only to find out that the only way they can unlock the capital they've created is by selling their portfolio. They never achieve the cash flow goals that they're after, and then they end up just like piling it all into super and hoping for the best, and it's not really the outcome they wanted. Right? So there is a better way of doing it, but you do need to get people who can think about it in a more agile way.
Yeah, and that's certainly where my mind goes in. If I was about to buy my first investment property, is going, okay, I know that I need these expert people around me. How do you actually know where they sit in that expert level? And if we just pull it down into the mortgage broker space, they might have 20 years experience, and you ask them the question, do you help build property portfolios? Yeah, I've built heaps in my time, but that doesn't actually answer the question of where their headspace is and what their understanding of the market is, and are they actually going to be the right person to help you along that journey? Do you have any thoughts on what people could be talking to their mortgage broker about to understand?
That is such a great question, right? And I am the very first person to say that ego metrics don't matter, right? So I don't think it is a good question to say, or how many properties have you got, mate? And have you? I don't think that's the right question. I think that can actually be counter to when we started. There's people out there that have got 20, 30 property portfolios. We don't have that. When we started, we had like two. But that doesn't mean that we haven't been able to help hundreds of people to achieve that. It's like, it doesn't matter, right? But a better question to ask would be how they think about it. So, for example, if they do have a whole bunch of experience and a whole bunch of clients and all of that kind of stuff, you could say, hey, just so I understand, like, what portion of your clients are property investors, right? Okay. What portion of your clients have bought more than 5 properties? Be a really good question, because they would have to have gone through that process to understand how to get them there. And then you could ask a question like, what is the most important thing that I need to pay attention to in order to be able to get to, let's just say, 10 properties? And then you need to judge the answer, right? Then you need to be able to use those kinds of questions to assess, like, how do they think about it? Because someone who knows what they're doing will tell you that, liquidity in the portfolio is paramount. Growth and cash flow are the only two things that you need. And if they start talking about interest rates and all of this other kind of stuff, then you're probably on the wrong track. Access to capital is way more important than interest rates.
Yeah, really interesting. Thanks.
No worries. Awesome.
Cool. Next one off the block. So a lot of our the family and friends of our team members are getting towards the end of their working life, and they're starting to feel like it's sort of too late for them to start investing in property. Is it even worth it now? Should I just not worry about property investing because they think that it's a long-term game, and they may as well just focus on something like superannuation, for example, to to take them into their retirement. What would you say to people that are in that headspace at the moment? Is there a time when it is probably too late to start investing in property?
Yeah. So the angle of that, because I knew you were going to ask me a question about is it ever too late to start investing? And I wasn't quite sure if it was the age angle or if it was like the market angle, right? So that's interesting. And we can kind of talk about the market angle because that's also interesting. But from the age perspective, it is quite fascinating, right? Because everyone needs to live in reality, right? And if someone's 65 and has got $50,000 of savings, and they say that I want to achieve a passive income of $100,000 before I retire in five years' time, it's important that we actually root our thinking in reality. That may not be achievable, right? Full stop. Now, there are some limitations when you do get a little bit older in that a lot of banks have like kind of age brackets that assess risk and stuff and your ability to repay the loan and do all this kind of stuff. And so your access to credit, which I touched on in the last kind of question there, access to capital is the most important defining factor in building a prolific, profitable property portfolio, not actually the cost of debt, right? And just to touch on that point again, if your return on invested capital is like 90% and your cost of debt is even like 10 or 20%, it still doesn't matter because you jump in the hurdle rate. So it's pretty simple maths. So cost of debt doesn't really matter. Access to capital does. But if you can't get the access to capital because of your age, maybe because have retired, if you have retired, it's, oh my God, I'm not a mortgage broker, right? So I don't know how that works, but I know that it is, it's either not possible or it's challenging or it's somewhere in that end of the vector, right? It's not a great place to be if you want to start building your property portfolio. But if you are getting to the later stages of your career and you are starting to think, oh, actually, I haven't done anything. And we have loads of people who we have helped in that kind of situation where, you know, they brought up a family, they've done the thing, maybe they've had a career and whatever, and now they're, you know, let's say in their 50s, and they're going, hang on a second, I've done all this cool stuff. We've lived a great life. We've holidayed with the kids. Now the kids are growing up, and it's just me and my partner, and we're now thinking about, well, okay, now we're empty nest, and now we've got our whole life again together, which they probably never had because the majority of their life it's actually been with their kids. So it's like, okay, well, what are we going to do now? And they're thinking, what's next? Now, if you're, say, 50 years old, and let's say you're going to live to your 80, you've still got 30 years. So if you go 50 and you go back 30 years, you're at 20, right? So it's like, holy smokes. So it's kind of like, it's a very interesting perspective to have, because if you're 20 and so what do you want your life to be like over the next 30 years by the time you're 50, think about all the things you can do. Think about all the things you did in the last 5 years, right? So it's a big, you know, spectrum to be looking at to go, wow, I'm 50. Now 50 is not that old, right? And this is why I chose 50, right? Because if you're in your 60s and 65 or whatever, you're going to have some structural limitations in terms of borrowing. 50 is a different kettle of fish. You're probably still working. You're probably doing all that kind of stuff. And you've still got 30 years of your life ahead of you. But you've also then still got to be realistic about what you're trying to achieve, where you're trying to get to, right? So understanding the goals and the timeline and the structural constraints, access to capital, total available capital, debt, all of that kind of stuff is really going to make a big difference. Now, if you're 50 and you're thinking about building a property portfolio for the first time, and you're wondering, can you achieve your goals? Then the answer would, and let's just arbitrarily say the goal was something like whatever, $100,000 cash flow. Well, the answer is yes, right? You've just got to do it intelligently, and you need to make really strong, decisive, assertive decisions over the next, say, 5 years to 7 years to be able to set yourself up for that goal, and then you'll be on the money. All good, right? If you are 65 and you are planning on retiring in the next 6 months or in the next, I don't know about 65, but let's say you're in that later end of the spectrum and you're thinking about retiring soon and you're going, I haven't done anything, and oh my God, my super isn't going to cut it, and the pension's not going to cut it, and help, what do I do? Now, is it realistic that you're going to achieve the same goal as someone who started investing when they were 20 or 30 or 40 or even 50? Well, no, it's not, but could it be a significant improvement? And we've had loads of clients like that as well, where we may not be able to help you achieve $100,000 of cash flow, but could we provide a much greater return on your capital than you otherwise would get anywhere else? And would that then contribute to improving the standard of living? Now, in that scenario, it might be a case of going, well, okay, let's make as many moves as we can until bank says no or whatever the case may be, and then we'll stop. and then you can let the portfolio grow a little bit. And then in that scenario, it might actually be the case that selling down the properties to access the capital, which is not the ideal outcome if you start early enough. But in that scenario, selling down the assets to access the capital, or potentially doing a reverse mortgage, but they're less common and not that great and stuff. There's other ways you can access the capital later. So is it still going to be a good idea? Yes, because the standard of living you have will improve, your wealth will improve, your everything will be better in your life, but you just need to be realistic around what those goals specifically are. Does that answer the question?
Yeah, it does, absolutely. And I think it might help some people move through some mental barriers, at least just asking the question. You might go to your expert mortgage broker and they say, you know what, it's not going to happen, but at least to ask the question, or just assume that it is too late, and actually engage and think about it in detail, I think is really empowering. So yeah,
100%.
Thank you.
And there's also self-managed super funds and all of these other kind of things that you can think about as well. So there are ways that you can make it work, but yeah, it really comes down to asking the question. Don't assume it's too late, right? Never assume that it's too late. It all depends on your situation. It all depends. Do you even need debt? Maybe you've got plenty of all this different stuff, and take the time to try, because what is at stake is the rest of your life. Like, and I don't want that to sound too fatalistic, but that is true. Like, what is at stake is the rest of your life. And if you go 20 years down the line and you haven't taken any action purely out of apathy and fear, and you live a life that is below the fulfillment or everything, or that kind of stuff that you really wanted in your life, then you'll regret it. So take the time, push the button now, push it. See if you can do something. Something is always better than nothing, and try and make some moves now, even if it isn't going to help you to, buy some private jet or whatever, or anything like that. But maybe it can still help you to get to where you want to take more around the world holidays or whatever. So definitely worth pushing the button.
Yeah. Beautiful. So I'm going to bring the focus into some capital city investing at the moment. So we're in Sydney at the moment, and you've got other capital cities around Australia, so Melbourne, Brisbane, those places. And so there are some property investors that like to buy in the capital cities. And I'll use Sydney as an example at the moment because we're there right now. Do you think that there will be a good time to buy an investment property in Sydney?
Yes. So I'll qualify that for a little bit, right? So there's no such thing as bad assets, only bad asset selection, right? So are there great properties to buy in Sydney? Of course there are, but does that mean that necessarily buying one is the right thing for your portfolio? No, it doesn't, right? Just because it's good doesn't mean it's good for you. And so understanding that first and foremost is critical, right? So typically, particularly if you're going to use debt, typically properties in Sydney are going to be negatively geared. Now, generally speaking, we talk about positive cash flow properties and all of that kind of stuff, and so this might seem like heresy, but actually, there's nothing wrong with having a negative cash flow asset as long as you understand where it fits in the rest of your portfolio. So if you've already built a property portfolio and you're achieving all your cash flow goals, and I know you got tempo, and you want to do something like that, then maybe it can work, right? However, certainly probably not the place you should start, and you should only do that within the context of actually understanding what is your portfolio mix, what is your efficient frontier, and all of these kind of things, which we've talked about on previous podcasts as well. So there's another part to the question, right? So there's kind of two parts to this. Like, is there a good time to buy a property in Sydney? Right? It's kind of like the broader kind of thing. Now, number one, there's like the market aspect of it. As we record this, Sydney's just had its biggest boom in ages and all that kind of stuff, and blah, 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 right? So is that even a good time to invest? Well, interestingly, I would say no. And if you go back to listen to the podcast, I've been saying since the start of the freaking pandemic that it's not going to be sustainable because there's a lot of underlying structural inefficacies in that. And it's past the stage of irrational exuberance, and it is probably going to pull back. So what does that mean for an astute investor? Yeah. If you time it right, if you wait a little while, it's probably going to be a great time to buy in Sydney, as long as it fits within the context of your portfolio, right? Because you can get great returns in loads of places. If I was a homeowner right now, if I was wanting to buy a home right now, I would wait probably another 12 months or so and look to buy at a lower price, because I believe that's what's going to happen in Sydney. I don't think that's going to happen everywhere. And you've got a lot of, in the media at the moment, there's lots of people saying, oh, property price is going to drop by 10 or 25% or whatever the case may be. No, like that's not true. Maybe some places, right? But there are 15,264 suburbs in the country, right? So some places are going to go up, some places are going to go down. That's the same. It always happens. Nothing's changed, right? So, but I don't think the housing market is going to crash. I think places like Sydney, where it reached a point of irrational exuberance in the market, I think that Sydney is going to be more susceptible to a price pullback or a correction because I think it became overstimulated. So I think that there could be a really good time to get some great priced assets, or at least fairly priced assets. Or what you'll probably find is that in trying to find its equilibrium, it's gone above where it should do, and then it'll probably go a little bit below where it should be, and then it'll find equilibrium. It's kind of going to bounce a little bit. And so if you can kind of get that right, then there's some great opportunities to buy some great assets in a place like Sydney. But again, you've got to think about that kind of like portfolio mix piece, because if you buy an asset, it might be a great asset to buy in Sydney, but if in doing so you get yourself stuck and you can't continue to move forward, you can't continue to buy more properties, if you can't continue to move towards your goal, then that might end up being the worst possible decision for your portfolio, regardless of the returns you get on that asset.
Mm. Do you find that major infrastructure projects make a meaningful difference to whether it's a good investment for your portfolio or not? So at the moment, the Badgerys Creek Airport's being built in southwestern Sydney. So would you think that something that major would have a useful effect on making it a better investment?
Not in the way, yes, but not in the way that you would think, right? So psychographics matter much more to property markets than any of the other stuff do, right? So, for example, let's take Bondi, Vaucluse, eastern suburbs kind of area of Sydney. Property prices grow pretty well there, right? Yep.
Yes.
So there are no new infrastructure projects happening there. None.
Not unless you're going to knock down some houses.
Exactly.
Yeah.
But there's no new jobs. There's nothing. Nothing has changed, right? Nothing has changed. The only thing that drives those prices is psychographics, desirability, the sense of status, the feeling you want to move up in the world, lifestyle, all of these other kind of things, all these softer things that are way harder to measure. Now, interestingly, we've actually been doing a lot of scientific analysis on the impact of projects in areas. And it is we totally expected to find that it was like some kind of like really direct correlation. Like, I don't know, if you had $1 billion worth of investment in an area, then an area would go up by X%. We expected to find something like that. Or if a hospital went into an area, then you would get 10% growth. And if a road went into an area, you get 5% growth. There's something like that. We expected to find some direct correlation between those kind of things. And what we found was that there is no direct correlation, right? So it's really, really, really complex, and we're still trying to decode that specific part of it. Broadly speaking, when you have capital that flows into an area and there is surplus capital floating around in that market, that drives prosperity, right? So if we take a different example, if we take a regional center, let's just say $100 million of fresh capital pumps into that area. Could be people who have moved to the area, they're getting higher wages, and there's new money that's come into the area. People are going to spend that money locally. They're going to spend it in the shops. The shop owners are going to make more money. They're going to want to buy a new car from the local car dealer, blah, 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 blah. And it becomes circular. Those economies get stimulated. There's all that kind of stuff that goes on. So all of that is, broadly speaking, true, right? But it's very hard to, you can't specifically say, because a certain piece of infrastructure is going into an area that is going to mean a certain thing. Really depends on the psychographics, because in an area where, there could be a bigger psychographic impact of putting in a hospital than in one area than in another. And so you can find examples where hospitals, for example, have created loads of growth. You can find other areas where a new hospital has gone in and prices have actually gone down. And probably it's not because of the hospital. It's probably just because the hospital didn't really matter in the psychographic profile of the people that are there. So in the context of the Badgerys Creek kind of scenario, there's three. Anytime there's like a major project like that, there are three optimal phases to buy to capitalize on that. So one is before the project is finalized. So when they're talking about it, but it kind of hasn't happened or nothing's been finalized. Bit speculative, right? But that's kind of where you get the biggest gains. But it's speculative, you could get it wrong because like a lot of projects don't move ahead. So that's kind of like the first stage. The second is when actually the construction starts, because there's a hive of activity and and all that kind of stuff. That's where the next big boost happens in the chain. And then the third is when it's completed, right? So they're the kind of phases. It's like before, during, and after. And then there's kind of arbitration of different stages in between. Now, a big thing about the Badgerys Creek thing is the psychographic. It's the sense of progress. You know, they call it Aerotropolis and stuff. That sounds so futuristic, and everyone's like, "Oh my god, we're going to have Aerotropolis. It's going to be like the Jetsons and like the."
I was thinking the Jetsons, yeah.
Yeah, totally, right, totally. And everyone's like, "Oh my god, there's going to be all of this stuff happening and all of these jobs getting created and all of that." Every one of those thoughts may have an element of truth, but is driven by emotion. It's like, oh my god, do you know there's going to be heaps of jobs? Well. There could be there could be the same amount of jobs being created somewhere else. But if you feel like that is the opportunity, then you are going to feel strongly about that being the opportunity. And then you create this kind of cycle of like a self-reinforcing cycle to a certain degree. So the Badgerys Creek project already has had a huge impact on property prices out there. And when all of that stuff is completed, it's going to have more of an impact. That doesn't necessarily mean let's all go buy around Badgerys Creek, right? Because you still have to look at things like efficient capital distribution. Like how much is a property going to cost? Is that the best place for me to put my cash based on the price, based on what it got, all of that kind of stuff? Where does it fit in my portfolio? Like, what are the yields going to be? Am I still going to maintain the liquidity I need to be able to, buy more properties and do all that? Like, there's all of these other kind of considerations because there are loads of places where you're going to get plenty of growth, but could actually be the wrong move for your portfolio. So, really understanding that. I'm not sure if I've answered your question. I've certainly waffled a bit. Did I kind of get there?
Yeah, I think so. It's just the headspace, and I think just really clearly defining that there's not a direct cause and effect. So just because there's a new airport or road going in doesn't mean that it's a guaranteed, house prices are going to be going up. It could, but it's not the only factor that goes into that driver.
Yeah. What's actually really interesting and kind of where we're at with the study is we've broken down the country into clusters based on industries of employment. So rather than geographical or political boundaries, we've clustered them based on weighting of industries of employment. So if a town has a higher percentage of, administrative workers, or if a town has a higher percentage of tradies, or if a town has a higher percentage of mining workers, or if these kind of like broadly speaking, these different clusters, because they imply a psychographic and demographic grouping. And then what we are doing is we are then analyzing what are the impacts of different projects on those kinds of groupings. Because, for example, in an area that has more, let's say, financial services, or let's say professional services and stuff like that, or more professionals, which is like group it that
bit more
like
white
that.
collar.
Yeah, a bit more white collar. You might find that entertainment projects. And entertainment, broadly speaking, could be anything from a new cinema complex to a new sports stadium to a new park or public facility that people can use for recreation. So we call it like entertainment and recreation is probably the better way to think about it. Those kind of projects tend to work better for those kinds of people, generally speaking. Vice versa, and I don't have the data in front of me specifically, but like if you're in an area that was more agricultural and trade, for example, you might find things like education and healthcare might have projects might have a bigger impact as well. So it's pretty deep, and it's like it really goes down to like what is the project, where is it, and what is the impact going to be.
Yeah, nice. Fascinating. I want to go into Badgery Creek now. I want to see what's going on out there.
I'm waiting for the Aerotropolis. Until there's flying cars, I'm not interested.
Not real. Yeah,
exactly.
Photos or it didn't happen.
Exactly. I'm mindful of time, Vanessa. I think this has been really good. Did you want to, we've got more questions, but do you want to maybe do we want to dig in a little bit further?
Oh, I think the last question is a really good one. Maybe we'll jump to that one because it's something that I've come across in my travels as well. And it's around the headspace when you're selecting a property or making a decision on whether to make an offer on a property. And so our clients and people that I know, family and friends, when they're looking at buying an investment property, if you're looking at buying an established property, chances are it's a little bit outdated. It might need a little bit of a renovation, a light renovation. Something's not quite right with the property from there. It's an expectation that's probably the case. What can sometimes happen is a client might look at that property and go, I wouldn't want to live there. Therefore, I don't think anyone else would want to live there. And there seems to be that mental connection and blockage for some clients and family and friends that stop them from maybe making a really good investment decision and putting an offer in on this property because they're thinking that they wouldn't want to live there and therefore nobody else would want to live there. Do you have any thoughts on how you mentally approach that roadblock in your mind?
Totally. So the first thing for people to remember is the key thing is that they already don't live there, right? And so by nature, that means that they've chosen like that is not their place of choice to live, right? That suburb, that area, that type of property or whatever. So understanding that, like you're a different type of person. That's like, like I am not German, right? So people in German are different to me, and they eat different foods to what I would eat, but that doesn't mean they're eating the wrong foods, right? So for example, so understanding that different people are different in different places, and we kind of move to the places that we want to be, and all of that kind of stuff is a really big thing. Moving to the kind of like, how do I bridge that kind of emotional kind of perspective? The problem that most property investors face is people don't make logical decisions. They make emotional decisions and then try and support them by logic. And that is fundamentally one of the big parts of the problem that we're trying to solve, right? That's why most property investors don't achieve their goals, right? And I'd say that plainly. Most property investors get it wrong and do not achieve their goals. That is a fact, statistical fact. So if you want to be one of the few who actually does achieve their goals, you need to approach it differently. You need to approach it with logic. You need to approach it by understanding what is the demographic and psychographic profile of the area, what is appropriate, what is in demand, all of that kind of stuff. And just because you wouldn't live there doesn't mean that somebody else wouldn't live there. I mean, Vanessa, I haven't been to your house. I don't know how you live, but you probably wouldn't want to live in the apartment that I live in because it's probably okay for me, but it's probably not okay for you, or vice versa, right? That doesn't mean that you're in a bad place or I'm in a bad place. It just means that we're different people with different viewpoints. And that's a really important thing to understand, right? Now, moving past that, you've also got the priced in value. So when you're looking at things like established properties in established neighborhoods versus new builds, for example, because new builds are shinier, they look nice, they look good, right?
Yeah, they're lovely.
Yeah. But there's a couple of inherent problems there, right? And there's loads of them, but I'm not going to go too deep into it. But one of the things you're paying for is you're actually all of the value is priced in, right? And also they're not in the most efficient, they're not in the most, how do I put this? The market hasn't found its equilibrium, right? So all areas were new once, right? So you can't, like, properties never existed forever. So all areas were once new. But what tends to happen over time is communities will build in those locations and all of this kind of stuff, and it'll become an established part of the locality. And then everything finds its equilibrium. Values find their equilibrium. There's constrained supply. There's certain types of people living there. And so that creates a more known quantum, right? Because there is an established equilibrium of what the environment is. You don't get that typically if let's say you're buying in a new estate. That doesn't exist. And so instantaneously you're operating in a more dynamic and highly variable environment with less known considerations and typically much higher supply risk, right? So inherently there's some problems there. But one of the considerations aside from that, just purely on the quality of the property, brand new, nice and shiny versus an established property where, maybe there's a couple of dings and dints on it. And, it's not talking about buying dumps and, complete fixer-uppers or whatever, but stuff that might need a little bit of maintenance. If you think about this from a business perspective, if you were to try and buy a business which was at its peak, it was roaring, it was like it's growing and it's super profitable and it's like at its peak, right? You're going to pay a premium for that property, right? if you were to buy that business, if you were to buy a business which once was at that peak, premium, looked beautiful and everything like that, but, it's had a little bit of degradation over time and it got some, legacy issues and it's not looking as shiny as it once was. It's maybe not, all that kind of stuff. You'll be able to buy that property at a discount, right? Basically. I don't know. I'm not suggesting that you're going to we're buying all of our properties at discounts and they're under market value and all that kind of stuff. It happens, but that's not the thesis of what I'm trying to say. The point is that you can buy something because you can unlock the hidden value that maybe somebody else can't see, or maybe the owners have kind of given up on, or any of that kind of stuff. And so there's a better value proposition because you won't be paying a premium for the property. You'll in fact be paying a more true value than otherwise, which is also one of the reasons that we like to focus on established properties. So yeah, I think it's an emotional piece for people to move past and to really think about, thinking about it purely as an investment rather than a home, I think is one of the problems people face as well, because they think, oh, I'm buying homes. I'm going to go buy a home. I'm going to buy a home. I'm going to buy a bunch of homes. Well, not really. A home is an emotional thing for somebody else. What you're buying specifically is a securitized asset, right? And that could be the same as a share, a bond, a commodity, or whatever. It just turns out that it is a property. And anyone who owns shares, I always ask them, like, when was the last time you went and visited your shares? If you own shares in BHP, did you go to the head office and suss them out and eyeball the management team? No, probably not. You just bought some shares and move on. So it's trying to distill that down to what it is, which is for investors, it's a financial instrument. Helps that too.
Really helpful. I think it's purchasing an investment property can be a really challenging thing, and it challenges your headspace and any preconceived ideas you have. You might not have even realized you had those ideas until you're confronted with something. And so no, it's helpful just to start to really dig into those and challenge your own headset when you're looking at the investment. So that's helpful. Thank you.
100%. Well, I've enjoyed this, Vanessa. So thanks so much.
Likewise.
And remember, guys, if you want to get your questions asked on the show and you want me to ramble on about some, theoretical response to your quite probably pragmatic question, then this is your opportunity. Just send an email to til@dashot.com.au. Shoot through an email. Let us know what your questions are. We're going to ask on the show. Vanessa, thanks so much for your time. Really appreciate it. It's been nice to have you on the show, and it's been some great questions that we've been able to dig into. So thanks so much. And we'll see you soon.
My pleasure. Thanks, Goose. See ya.